Traders flock to the dollar as President Trump's trade war intensifies. The greenback jumped the most in 3 weeks after President Trump announced a wave of proposed tariffs on Monday. But the dollar index, which measures the currency against six major peers, is still down more than 6%. That's since Trump's Liberation Day tariff unveiling in April, a day that shook investor faith in the US currency. Jeremy Stretch is Chief International Strategist at CIBC Capital Markets. So Jeremy, what's different with this week's announcement? Why is the dollar rising?
Well, I think the difference between this move and the Liberation Day move was, of course, the Liberation Day tariffs were relatively unprecedented. Certainly, they were amplified compared to market expectations, and that really allowed or prompted a significant re-rating of appetite for US dollars and dollar-based assets. This time around, we're looking at a slightly more sectoral approach or a slightly more country-specific dynamic. But I think it's also the case that we have seen a significant build-up of dollar shorts over the course of recent weeks. And it may be just a little bit of short covering and a short covering rally in terms of the dollar, at least into this early summer period. I don't think necessarily it's the end of dollar negativity. But as I say, I think it's just a pause rather than a full-on reversal in terms of the dollar downdraft that you've mentioned since that Liberation Day process at the beginning of April.
But overall, the moves aren't extreme. Are traders largely ignoring the trade noise, or is this the trend going forward?
Well, I think investors have become a little more sanguine regarding the risks relating to the tariff story. So I think we're obviously seeing significant degrees of headline risk over the course of the last few months, going all the way back to even before the inauguration. So I think we've had a lot of headline risk, and I think in a sense we've seen traders starting to look through that. As we know, we have had a succession of deadlines. Those deadlines seem to come and go with almost increasing regularity. Now, of course, we have another one for the 1st of August. Now, Trump may say he's not prepared to punt that forward, but of course, markets are still not necessarily convinced that is going to be the case. So it is still this sort of scenario where we've seen a lot of headline risk. We've gradually seen a reduction in terms of those sort of immediate market reactions, because I think people have learned that reacting on a headline is perhaps sometimes a painful and or costly move.
Analysts as well have warned another 10% dollar depreciation in the second half of the year should mean inflation at 0.5 percentage points higher than expected. So are Fed alarm bells ringing over the dollar?
Well, of course, if the currency does continue to cheapen and or price dynamics are pushed higher by the tariffs, then that is going to create an inflationary impulse, which will cause some consideration and concern for the Fed. I think what we have to remember, of course, is the Fed, unlike most other central banks, has a two-sided formal dynamic in terms of its policy narrative. And I think the Fed may well find itself leaning a little bit more on its employment components and employment backdrop into the second half of the year, particularly if the price dynamics are perceived to be one-off. So if we see a one-off adjustment in prices as a consequence of the tariffs, then I think the market will, and the Fed can perhaps ignore some of those immediate price implications as long as inflationary expectations remain reasonably well anchored, and perhaps focus a little bit more on any weakening in the labour market through the course of the second half of this year.
Meanwhile, Treasury Secretary Mnuchin has rejected worries over the dollar's decline, as well as its status as the world's key currency. Is everything going to plan for the US administration?
Well, of course, the US administration have consistently repeated the mantra, which goes all the way back to the mid-1990s and Robert Rubin, of a strong dollar is ultimately their preferred aim. But ultimately, I think there is a case that they are quite happy to tolerate a slightly cheaper dollar because, of course, that will enhance the export capabilities of the US and will make those imports into the US also more expensive or less competitive, even before you start to get into that tariff narrative. So I think the US are not overly concerned, although having said that, they do need and require the continued appetite of foreign investors to refinance that Treasury debt mountain, which, of course, has only got a little bit bigger over the next decade after the one big, beautiful bill. So I think the Treasury Secretary is not overtly concerned by the cheapening up of the dollar, as long as there is continued appetite in order to facilitate the issuance of debt as we move forward.
Finally, Jeremy, traders are starting to seek alternatives to the euro when shorting the dollar. Where should we be looking?
Well, you're absolutely right that the euro has been the obvious currency of choice when you are looking at alternatives to the US dollar. I think there are still pockets of opportunity in terms of other liquid currencies. I think the yen is still one where there can and should be some degree of value. There is a depth in the bond market, so I think that's worth keeping in mind. And I think in the context of those liquid non-dollar currencies, I think sterling, Australian dollar, Canadian dollar will continue to see some degree of residual appetite, as well as obviously central banks and sovereigns have been looking at the gold market as an alternative to holding excess levels of reserves in US dollars. So I think there will be this continued search for non-euro based assets. But even within the eurozone, I think it's interesting that whilst we've seen obviously significant appetite for German bunds, if you look at the compression in terms of peripheral bond spreads, that underlines that peripheral bonds have also been seen as attractive alternatives to US treasuries within the European time zone.
That was Jeremy Stretch of CIBC Capital Markets. Don't forget, you can watch more videos on Reuters.com.